Well, the key features of an absolute return fund are capital preservation. So, not losing money, but also there is a focus on generating returns from alpha generation. So in other words, your stock ideas instead of movement in the market. And also another characteristic of an absolute return fund is uncorrelated returns. So markets can go up or down, but an absolute return fund, the real focus is to generate positive returns throughout any market.
And why they're increasing in popularities, I mean, especially during the GFC, where we saw markets down 30-35%, a good long-only manager, and 90% of the funds in Australia plus are long-only fund managers, if they did 25% down when the market was down 35%, thought that was a great result, but the end customer still lost 25% of their money.
The investment philosophy around the pure equity alpha fund on the long side is exactly the same as the investment philosophy that we use across all of our perpetual Australian share funds. So we focus on quality and value, and what we think is quality is we actually look through the listed market and we filter the market through 4 quality lenses, which is sound management, a strong balance sheet, recurring earnings, and a quality business.
On the short side, what we like to do is I look at all the stocks which the analysts out of Perpetual have kicked out for quality reasons. And that comes into my universe. The second thing I do is anything that the Perpetual analysts have rated to sell, again comes into my universe. We have a filtering process after that where we basically examine the behaviour of management teams. And we've got the general view that management teams tend to know the bad news or before the market do, whether consciously or subconsciously. So analysing their behaviour is very important. Insider selling, a CFO suddenly leaving, a strange acquisition is usually an indication of a future hole in earnings. I call it diversification. I think over-promotional management or management which berates analysts for having a sell recommendation. Finally, when accrual earnings are well above sustainable cash flow earnings is usually a sign. None of these are be-all and end-alls that this is a short, but it's a good indication that they're good shorting candidates. Then doing my own independent work, finding the ones where we're materially below the market in terms of valuation, handing it over then to Paul, who sizes and times and risk manages the position. It's sort of that's our process.
Shorting experience is very important, I believe, and the reason why it is a different psychology to buying a stock. Typically when people want to make money on the market, they will buy a stock and wait for the stock to go up. When you're shorting, it's totally a different mindset. It's actually going against the herd. And when you do short a stock and it is in your portfolio, when you're wrong, it actually becomes a larger part of your portfolio. So what's very important is having experience on how to manage that risk. So we feel that where we have an edge, Anthony and myself, is that we have extensive experience on actually shorting over a long period of time, and we feel that that provides an edge.
We've also got different skill sets. Paul's very much big on risk management, focusing on sizing and timing the positions, whereas I'm more fundamental in terms of a lot of the ideas which we come up with. They're the main skill sets.
In recent times, IAG's been a big performer for us on the long side. We identified IAG as a stock that we wanted to own very early on at around the low $3 mark. The reason why it was out of favour, it had a UK business that wasn't particularly doing well, but the underlying business, the core business in Australia and New Zealand, was doing extremely well, but it was being masked by these issues, one in the UK, but also there was a run of weather events that also had masked the underlying operating potential of the business and what it was doing. So we identified that early, and what we've seen is, subsequent to that, is the stock is now closer to $6, and the reason why is they've sold the UK business, there's less weather events, and the stock is re-rated. So that's been a great performer for us on the long side.
On the short side, where we've made a bit of money, has been quite a lot of this raft of recent IPOs. There's been a lot of IPOs recently, and what we find, especially the ones coming out of private equity, is that the vendors of the shares have really stripped the balance sheet bare, are really selling at the top of their earnings cycle. And in fact, in a lot of cases, their earnings are inflated by what we consider a lot of non-recurring items. And so we've made quite a bit of money on a couple of recent IPOs where we've shorted just after IPO.